Hello and welcome to Technical Analysis 101, brought to you by TackleTrading.com. Hello and welcome back to Technical Analysis 101, module number 4, numero 4. And again, my name is Noah Davidson. I am your coach and tour guide through the Technical Analysis 101 series. We've already laid the groundwork for trend in the previous module, which you'll recall. And so that means we'll be able to readily understand downtrends more quickly, and we can have a little bit more fun with this module because we've already got it. We're going to review the general price cycle again and how it behaves in a downward trend. And then we're going to simplify the downward trend pattern so that we can spot it more readily. We're going to identify how and when a downtrend starts, and then identify that lower low, lower high pattern, lower low, lower high pattern that defines the downward trend. We're also going to see how our favorite chart types, those Japanese candlesticks, behave within the context of the downtrend, and those rudimentary patterns that tip us off to help us see with the tops and the bottoms of those cycles. And then we're going to work on multiple time frames, from weekly charts to daily charts, all the way down to intraday charts, where we can see the behavior of the downtrends. And then we'll take a little bit of time to learn what defines a bear market. And then we're going to review some bear market data from the history, from the past, so that we can understand the nature of bear markets better before we go live and put everything we've learned here in action. So let's get with the trend, my friends, the downtrend that is. Let's jump in and have some fun. Now, we're already familiar with the price cycle within the context of the downward trend, but just take a moment to review with us. Again, we'll see the market price start to drop. We see that first break of support, market price start to drop. We'll see prices drop as it goes through a markdown phase. It'll hit an accumulation phase. We'll see some buying come in as it's oversold, and you'll see prices rise up. And you'll see prices rise up through a short-term markup phase. You'll see it get to an overbought condition where it's slowing down. You'll see a distribution, and you'll see that distribution hit the tipping point, and then it'll hit the drop-down phase. And you'll see that during the markdown phase, and you'll actually see the prices drop relatively steeply. You'll see it come down, establish a new lower low. You'll see a price rally back up short term. Now that short term rally, that markup phase doesn't last long after you see it bottom out. It'll run up for a little bit, and the old accumulation zone should become the new distribution zone. And you'll see it make a lower high before it tips over and starts to hit that markdown phase again, because you got motivated sellers in a downtrend. Again, we got really motivated sellers in a downtrend. Now, let's simplify this pattern so we can understand it and spot it more readily. And it starts out again with that first clear selling signal. We see that first clear selling signal, and we'll see that markdown phase continue. After the markdown phase drops, we'll see prices get oversold, and you'll typically see the price pattern slow down with this small candles, or a cluster of candles, small candles. Well, you see a new lower low established. Prices will rally back up through the markup phase after it's come through the accumulation phase, and you'll see it slow down, hit a tipping point with smaller candles, establishing a lower high. Now, that's really important. It's got to be a lower low, lower high. We see it go through a markdown phase again. Prices drop, typically with some good momentum. It'll break the old lower low, establishing a new lower low. After you'll see a small group of candles or clusters or small candles signaling it's possibly ready to go back up. If we see it run back up, now we're watching for the old low to become the new high in that ballpark or in the trend zone. And once we see that new lower high come in, we're really establishing a downward trend. That's really important to note. We're really easily understanding what's going on with the downward trend here. So now we see it tip back down, break the support zone, establish a new lower low, again lower high, lower low, the pattern repeats. So that's the idea. Once we see those opportunities, this gives us an opportunity to sell. And in a bear market, we can actually make some money here. Now, this is not something that new traders often understand too easily, but it's not hard. We can sell high first. We can actually short sell. And when we get those selling signals, that creates an opportunity for us to borrow the stock. Step 1, borrow the stock. Step 2, sell, get paid at the higher price. As prices drop, step 3, we can buy them back, and step 4, it automatically returns it to the broker. So again, it's basically sell first, buy second, and you can make money in the drop. Now, we understand the basic pattern, and here we're seeing kind of how that tipping point works and how that first new lower low works. A downward trend starts with a failure of support. Again, write that down. A downward trend starts with a failure of support. It has to break a support zone, establishing a new lower low. Once we've broken a support zone and we've established a new lower low, what we're going to watch out for is the repetition of that lower low, lower high pattern to confirm a downward trend. So here's what it looks like again in context. You'll see the price make a new lower low, lower high, breaks down to a lower low. You'll see the price rally up. You'll see those small candlesticks again, very, very common. If we look at it, you'll see again consistent little pattern here where you'll see small candles hit those tipping points. Again, not always, but most of the time it's a very consistent tendency. And you'll see those small candles that establishes a new lower low. And again, it's that failure of support that really clearly indicates the downward trend. You'll see small body candles, again, signaling a lower high. You'll see prices drop down. If it breaks that old support zone, you'll see it establish a new lower low. And we see that little support zone right there come in with a small body candle. We already know that that's the old threshold, so we got a lower low. We're watching out for that lower high to form, typical small candle. And again, you see that stair step down, lower low, lower high, lower low, lower high. The same oscillation we're used to. So we understand how that pattern works. Now what we're going to do next is we're going to look at how the trend works in the macro cycles and in the micro cycles trends. So we're going to switch gears here and just look at that big cycle picture again. Now we are already familiar with macro and micro cycles. We're going to look at them in the context of a downtrend. Of course, we're going to understand this really easily because we've already seen it in the context of the uptrend. But the same general pattern exists. You'll notice again, you'll see that same general big macro pattern with the lower lows and lower highs being established, big swings, lower lows, lower highs. You'll consistently see the old threshold at the bottom become the new threshold at the top. And you'll see that big macro lower low, lower high pattern. You'll see that. Now, it's important to note that within the context of that big macro pattern, you'll see the micro pattern. You'll see the starting to establish lower lows and lower highs, lower lows and lower highs. You'll see that same general pattern of lower low and lower high. And again, you'll see that oscillating around a mean. And you'll see that the downward moves are pretty quick. And then you'll see some quick short-term up rallies that don't last long. You'll see sideways cycles in the context of that trend as it hits accumulation and distribution zones. And again, we understand how the big picture pattern works. It's just how quickly and readily available we are able to spot it. And if you look at the pattern here, you'll also notice that you can see the context of the big downward channel occurring here, and that as it oscillates around the mean is in the middle of the channel. So you got that, establishing lower lows and lower highs, kind of under the extreme, but it follows that mean and oscillates around that as we establish a primary downward trend. Again, the context. Now, this could be on all time frames. It could be on a daily chart or a weekly chart or a big monthly chart, or you can see it down on intraday charts as well. So now let's take a look at some chart examples so we can understand that context of that cycle inside those trends. We're going to look at weekly charts, daily charts, and we're going to understand how channeling works, and we're going to then talk about how bear markets work. So this is an example of a daily downtrend chart. And again, you can already see the cycles in it. So let me actually just kind of point out the general trend cycles. So first, this actually has a little bit of an upward trend over here on the left. And you can see it establishing higher highs and higher lows until it gets out here. You see a lower high. That's one of the first real strong clues that we might be slowing down. We see it establish another lower high right here before it actually violates and breaks the support zone. So this downtrend starts when we see it fail a support zone here. So we actually notice here that we've got this first real strong support zone that breaks. So right here is kind of where it breaks, and again it reestablishes that downtrend when it breaks the next zone. And we're starting to see it establish that overall pattern of lower low, lower high, lower low, lower high. So we're seeing it again start to establish that lower low, lower high, boom, lower low, lower high, looking just kind of testing. And then when it breaks down, boom, little retest right there, drop. This is called a kiss goodbye. So they call this big retest here the kiss goodbye. Now, it's also known as the kiss of death. Dun, dun, dun. If you want something a little bit more dramatic. When it first makes that really obvious lower high, lower low, and you see that hit that first major support resistance bounce where you see it come into that zone, and it starts to drop, that's the kiss of death or the kiss goodbye. And it's a really powerful signal that this downtrend starting here. So right here, boom, kiss of death, break support. And you're starting to see, again, same thing. You'll see the clusters of small candles out at the tops and the bottoms. You'll see those little signals for you as it hits those clusters. You'll also start to notice that as the downward trend starts to increase, the slope of it just starts to really kind of drop, and the momentum, the downward momentum actually starts to increase. And that's really, really common when people get scared, when people panic, when there's no more demand for the stock and all you have really left are people who are trying to liquidate, prices can stop and drop to, go into a steep decline. And so when we spot a bearish opportunity, we spot a downtrend forming, and if we know that the security or the asset doesn't have fundamental strength, maybe it's in a sector that's trending down, a part of the economy that's struggling, a company that's in trouble, what have you. When we see that start to tip and start to really accelerate, that's when easy money-making opportunities can appear where we can short sell the market or we can buy put options and make some money on the drop. We can speculate on the drop. And when we spot it and see it going down, it's going to become like shooting fish in a barrel a little bit because it becomes easy picking. All you have to do is try to catch the short-term, short-lived rallies, watch for the signals to sell. Now that's, again, just a daily chart. We'll see the exact same core patterns here in the weekly chart. So again, weekly chart here, we see it establishing lower lows right out of the gates. We can see it kind of chopping sideways for a period where the price cycle is just moving sideways. Then we see it break down, establish new lower lows. We see it rally up here, lower high. Now that's the same kiss of death. Dun, 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 kiss of death, KOD. And that becomes one of the very strongest signals for downward trend. We see it establish, boom, lower low, lower high. And again, lower low. We see lower high. We know we are in a downward trend. You'll see short-lived rallies. You'll see small candles at the tops, small candles at the tops, small candle clusters at the bottoms. You start to get the picture that this trend pattern is pretty obvious. And when it persists, there's going to be selling opportunities in there. You're going to see opportunities to sell. You're going to see opportunities to sell high and then eventually, buy low and make some quick money. And again, those patterns will repeat. Here's a support threshold, boom. You see the small candles, that's another opportunity to sell as it establishes lower highs and lower lows and downward trends persist. Until eventually you get to the point where the security is either going to get down to what's called intrinsic value or book value, where the company's assets are worth the price of the security, and it has to drop pretty far. And again, downtrends don't necessarily last long term. They're relatively short-lived. I mean, they can last for a year, maybe two, but on average, you'll see downtrends last for 3, 6, 9 months or so. And when you spot them, and there's an opportunity, and of course, the whole market's in a bear market, there's going to be huge opportunities for us to have there. Now, you'll also notice the same core channels within the context of a downtrend. Now, this is a pretty volatile little downtrend here, but you'll notice the downward channel, the mean, and the oscillation around that channel. So we're starting to get really, really comfortable with this pattern. We're starting to see that big oscillation, and you'll notice some patterns. Now here, I'm going to introduce you to a couple other chart patterns that we're starting to learn. We introduced them to you, I think, earlier on in one of the earlier segments, but you see patterns like W's, and you'll see M's for murder, and you'll see M's at the tops, and you'll see W's at the bottoms, and you'll see that pattern persist. There's other reversal patterns in there, but those patterns are how we transition from those higher highs and higher lows, and you'll see upward channels crossing across that trend, but the big oscillating pattern is still down. And when we spot that pattern, we know we're in a downward trend. There's going to, again, be opportunities for us to make some money. So you're seeing downtrends, you're understanding the patterns. What we're going to do next is define what goes into an actual bear market and look at some historical data, and then we're going to go live and look at some live charts. So here we are, as promised, the definition of a bear market. When we see the whole broad market declining, and we see a lot of the sectors declining, and most of the sectors, quite frankly, we need to establish a downward trend of more than 20% in order for us to be in an official bear market. Now, again, up to a 20% decline is not necessarily a bear market, but once we go beyond a 20% decline, we have entered bear market territory. So we're going to always watch out for that and become vigilant, because once it dips past 20%, people get scared, the bears get greedy, and we see lots and lots of inventory come in, people selling, offloading, short sellers come in, and the market tends to drop pretty hard. Here we're looking at some data going back to 1926 all the way up to past 2011, pretty close to current day. And it's measuring how many crashes there have been and what percent the market crashed. So you can see that, the crash of 29 got you down to like 1931, where you saw it down 80%. Pretty big drop. Biggest drop in history. You'll see, again, a couple of others. We got 2, 60% there. You got 3, around 40, 50%. You got minor dip in 1961 recession. You got a notable dip in 76 or so, 75, 76. You had the crash of 87, Black Monday, really only came down about 25, 30%. And then you've got the crash of 2001, pretty good drop, about 40%. And you got the crash of 2008, came down almost 50%. And so really you only have 10 crashes over the last 90 some odd years. And the average duration of a bull market is between 5 to 10 years. And here, at the time of the recording of this, we're 9 years into a bull market. And so we're vigilant. We know the markets might be overvalued a little bit, but that's the general idea, that the markets do crash from time to time, about once a decade or so. Could come more common than that, but the reality of it is that it's not that frequent. Here we're looking at some data on the S&P 500 for crashes of 20% or more. And you can actually see they've got some information in here from start date for the crash to the end date, and then the number of months that it lasted. And I actually wanted to go through the number of months. You can see, it lasts on average 1.9, 8.3, 3.3. You're not seeing huge numbers, 6 months, 3 months, 5 months. You'll see a couple large numbers, 13. Here's one that lasted 17.9 months. 14.9 months, 18.1, 21 months, 20 months, 18 months, 13 months. Really, the high is 21 months. And so, the median is around 8.3 months. The maximum is 21 months. The minimum is 1.9 months. The average is 10 months. So, and you can look at the percent crashes. Again, you can see ranging, 44, 32, 61, so on and so forth. A lot of data in there, typically 20 to 30%, a couple of big numbers. And if you come down and look at the median, it's about 35%. The maximum is about 61%. And then the minimum is about 20%. And so you've got the average at about 35% correction. And that's what we should expect in a typical market correction, probably around 35%. If we get the market, really, really spooked like it did in 2008, we can see a bigger correction than that. Alrighty, now that we've looked at some of the definitions of bear markets and understood some of the historical numbers behind bear markets and the big downtrends, it's time to go live and take a look at a few live charts. Again, we're going to go to a weekly chart, down into a daily chart, down into an intraday chart, and you're going to see downward trends, the cycles, the whole 9 yards. So buckle your seatbelts, and here we go. Okay, so here you see we're looking at a 5-year weekly chart on GameStop. You can see the downward trend and channel. You can see it stair-stepping down, lower lows and lower highs. You'll see, key support zones breaking. You'll see that small body candle on the tops. and on the bottoms of trends, you'll see that consistently. Again, stair stepping down, lower low, lower high. You have downward channels. You got the whole 9 yards. We'll see the exact same patterns as we switch to a daily time frame here. We'll drop it down to a 1-year daily. And again, gaps in the chart, that's probably caused by earnings, but you'll see small body candles at the tops. You'll see small body candles at the bottoms. You'll see a general downward cycle, channel. You'll see a median price in the middle. And again, you see that general move down, same stair stepping pattern, lower lows and lower highs. You guys get the picture, right? So now let's drop this down into the last, 10 days, 30 minutes or so. And you'll see similar cycles again. You'll see the stair step here. We're actually seeing a little bit of an upward rally, big downward drop as it fails support. Rallied up, kind of chopping sideways right now. We could probably back that out to a little bit longer time frame. Let's go 20 days, 1 hour here. And there we go. We can see the big downward cycle, lower low, lower high, lower low. Same type of pattern, seeing it stair step down there as well. So there you have it. The live chart does not disappoint. Exactly what we expected to see, the exact same patterns. And this has been a lot of fun here in session 4. Join us in a moment for session 5, and we'll see you there. And there you have it, ladies and gentlemen. We made it to the end of session 4, downtrends and price cycles. And what we have just learned is that there are price cycles in a downward trend. And we have established that the lower lows and lower highs are what define the downward trend. Downward trends, again, starting with the failure of support. Number 3 here, short, intermediate, and long-term trends. They all have the same basic patterns. We see them. We can actually identify the cycles and the stair stepping in all of those time frames. And number 4, a bear market is not technically established until the market has dropped at least 20%. Anything beyond 20% is bear market territory.